All right, welcome to The Explainer. Today, we're jumping right into the heart of business, something that anyone who's ever thought about selling anything needs to know. We're talking about profit and loss.
I mean, have you ever really thought about it? Picturing yourself setting up shop, stocking those shelves, and hearing the cha-ching of that very first sale. Whether it's a real-life store or something online, it all starts with understanding the basic numbers. And you know what? The great news is you don't need some fancy business degree to get this stuff. The entire massive world of commerce, it's really built on just two core ideas. Let's dig in. Okay, so let's follow our animated shopkeeper here. Their journey begins with the very first step. You see, before you can sell anything, you have to buy it first. And that brings us to the two most important prices in the whole game.
First up is the cost price, which we'll just call CP. This is ground zero. It's the money our shopkeeper has to shell out to a supplier to get their hands on the goods, whether that's a new line of sneakers or a fresh batch of cookies. It's simply what it costs to get the product in the door.
And then on the other side of that coin, you have the selling price, or SP. This is the price tag the customer sees. It's the money that actually comes into the cash register when that customer decides to buy.
Honestly, it all boils down to this super simple idea. Cost price is the money you pay out. Selling price is the money you get in. That's it. This balance of money out versus money in is what makes every single business tick. So our shopkeeper has their stuff. Now what? Well, now comes the fun part. A little bit of art and a little bit of science. How do you actually decide what to charge? And just as important, how do you make people want to pay that price?
It's usually a three-step dance. You start with your cost price, right? Then you add something called a markup. That's the extra bit you add on top to cover things like your rent, your lights, and hopefully to make a little something for yourself. Add those together, and you get your marked price. That's the official sticker price you put on the item.
But any smart shopkeeper knows that a sticker price isn't always the final price. Sometimes you need a secret weapon to get people excited, and that's where discounts come in. A discount is just a price cut from the marked price designed to get a customer's attention and close the sale. Okay, now lean in for this one, because this is a golden rule of retail. Look at how this works. The discount is calculated on the marked price, not the price the shopkeeper originally paid. This is a biggie. Discounts are always based on the price tag the customer can see.
All right, the doors have been opened, stuff has been sold, discounts have been given. At the end of the day, when the lights go off, there's really only one question that matters. Do we actually make any money? It's time to do the math.
And you know what? The formulas here are so simple and elegant. If your selling price was more than your cost price, congratulations, you've made a profit. It's just SP minus CP. But if you spent more than you brought in, if your cost price was higher than your selling price, that's a loss. CP minus SP.
Now, when we talk about profit or loss percentage, there is one rule to rule them all. As this quote says, that percentage is always calculated based on the cost price. The CP is your anchor, your starting line, your 100%. Everything is measured against what you paid in the first place.
Okay, enough with the theory, right? The best way to really get this stuff is to see it in action. So let's put on our shopkeeper hat and solve 3 common problems they might run into.
So here's our first challenge. Our shopkeeper bought a fan for 1,000 rupees. Ouch. But for whatever reason, they had to sell it at a 15% loss. The question is, what did it actually sell for?
Let's walk through this. It's a two-step process, super straightforward. First, let's figure out the loss in actual money. What's 15% of that 1,000 rupee cost? It's 150 rupees. Okay? Step 2, since it was a loss, we just subtract that 150 from the original cost.
And there we go. 1,000 minus 150. That gives us a final selling price of 850 rupees. A tough day at the office for our shopkeeper, but the math is crystal clear.
All right, problem number 2. This one's a little trickier. A scenario with back-to-back discounts. A 10% discount and then another 20% off. Now, a really common mistake is to just add them up and say it's 30% off, but that's not how it works.
This shows it perfectly. You start at 600 rupees,
The first 10% discount comes off that price, bringing it down to $540. But here's the key. The second 20% discount is calculated on the new price of $540, not the original $600. So that brings the final selling price all the way down to 432 rupees.
Okay, here's a classic. This is the kind of brain teaser you see on exams all the time. It sounds tricky. The money you spent on 12 candles, you earn back by selling just 10 of them. So you know it's a profit, right? The other 2 candles are pure gain. But what's the percentage?
Well, there is an amazing shortcut for this exact type of problem. Anytime the cost price of X items is the same as the selling price of Y items, you can use this simple formula. You just take the difference in the number of items, divide it by the number of items you sold, and multiply by 100.
So let's just plug our numbers in. X is 12, Y is 10. So you've got 12 minus 10, which is 2, divide that by 10, multiply by 100, and boom. Just like that, you know the answer is a 20% profit. So much faster, right?
We've covered a ton of ground here, from the absolute basics to some pretty clever shortcuts. So to wrap it all up, let's put together your own personal toolkit, the essential rules you gotta remember to win at this game. So let's lock these in. These are the golden rules. First, your profit or loss percentage always goes back to your original cost price. But discounts, they're always based on the marked price, the one on the tag. If you have multiple discounts, you have to do them one by one. And finally, don't mix up your initial markup with your final profit. They are not the same thing. And there you have it. You now speak the fundamental language of business. Cost price, selling price, profit, loss, it's all in your vocabulary. You've officially got the toolkit. So the only real question left is, what are you going to build with it? Thanks for joining us.